How's everybody doing? Welcome back to another episode of the Banker Next Door. I am your host, Dr. Joe Berquist. Today, I wanted to talk about the bankruptcy of Synapse. And I wanted to talk about, Synapse is a financial technology company which basically uses what's called the BaaS, Banking as a Service model. That is a model that has really come under fire recently from regulators. And I want to kind of get into all this. It's a very complicated situation. There's missing money. There's a lot of fingers being pointed in all directions right now, but I want to see if I can kind of build this story for you here to kind of explain what happened. So let's take a look at something here for a second. So Synapse Financial Technologies, Inc. Filed for bankruptcy. So Synapse Financial Technologies, Inc. filed a voluntary petition for reorganization under Chapter 11 in the U.S. Bankruptcy Court for the Central District of California on April 22nd, 2024. The debtor listed its assets of $2.35 million and liabilities of $13.04 million. The debtor is represented by such law firm. But let's go down here and look at a little bio of kind of what they do. So Synapse develops software for banking and financial technology companies. The company provides a suite of banking tools. Its products include payment solutions, deposit solutions, card issuance, loan products, account aggregation, and platform compliance. Synapse was formerly known as Synapse Payments, LLC, and changed its name to Synapse Financial Technologies, Inc., on August 8th, 2017. The company was founded in 2014 and is based in San Francisco, California. On April 22nd, 2024, Synapse Financial Technologies, Inc. filed this voluntary petition to reorganize under the Chapter 11 Bankruptcy Code. So just to give you guys a little bit of background about some of the services and products that they perform. So this company's been around since 2014. They kind of changed their name. They went from LLC to an incorporated to a corporation in 2017. They provide a suite of banking products. And now let's take a look at, kind of what happened here. So let's take it. So here's an article from CNBC. This is from basically last week, Friday, June 7th. So Synapse bankruptcy trustee says 85 million of customer savings is missing in fintech meltdown. So let's hit some of the highlights here. So there is an $85 million shortfall between what partner banks of fintech middleman Synapse are holding and what depositors are owed, according to the court-appointed trustee in the Synapse bankruptcy. Customers of fintech firms that used Synapse to link up with banks had 265 million in balances, but the banks themselves only had 180 million associated with those accounts. Trustee Jelena McWilliams said in a report filed late Thursday. What's worse, it's still unclear what happened to the missing funds. So this is spicy, very spicy. So there is an $85 million shortfall between what partner banks of fintech middleman Synapse are holding and what depositors are owed, according to the court-appointed trustee in the Synapse bankruptcy. Customers of fintech firms that used Synapse to link up with banks had 265 million in balances, like we said, but the banks only have 180 million. The missing funds explain what is at the heart of the worst meltdown in the U.S. fintech sector since its emergence in the years after the 2008 financial crisis. More than 100,000 customers of a diverse set of fintech companies have been locked out of their savings accounts for nearly a month after the failure of Synapse, an Andreessen Horowitz-backed startup, amid disagreements over user balances. While Synapse and its partners, including Evolve Bank and Trust, have lobbed accusations of impropriety, moving balances or keeping incorrect ledgers each other in court filings, McWilliams' report is the first outside attempt to determine the scope of the missing funds in this mess. Much is still unknown. Since being named trustee on May 24th, McWilliams has worked with 4 banks, Evolve, American Bank, AMG National Trust, and Lineage Bank, to reconcile their various ledgers so customers could regain access to their funds. But the banks need much more information to complete the project, including understanding how a Synapse brokerage and lending business may have impacted fund flows, said McWilliams. She said Synapse apparently commingled funds among several institutions using multiple banks to serve the same companies. What's worse, it's still unclear what happened to the missing funds, she said. So they don't even know where this money is at. The source of the shortfall including whether end user funds and negative balance accounts were moved among partner banks in a way that increased or decreased the respective shortfalls that may have existed at each partner bank at an earlier time, is not known at this time. That's real clear. Mick Williams, former chair of the FDIC. Yes, you may remember Mick Williams if that name was familiar to you, as she is to most bankers out there. And now is a current partner at the law firm Krabath, didn't respond to requests for comment. So spreading the pain. So McWilliams' task has been made harder because there are no funds to pay external forensic firms or even former Synapse employees to help. She said in her report, Synapse fired the last of its employees on May 24th. Still, some customers whose funds were held at banks in what's called demand deposit accounts have already begun getting access to accounts. But users whose funds were pooled in a communal way known as for benefit of or FBO accounts will have a harder time getting their money because it's not there. A full reconciliation will take weeks more to complete, she said. And then this is a crisis. So at the start of the public hearing on Friday, McWilliams told BaaS that her recommendation was that all FBO customers receive partial payments, which will partially alleviate the effects to end users who are currently waiting locked out of access to their funds while keeping a reserve for later payments. But comments from BaaS cast doubt on how that would move forward. While profusely thanking McWilliams for her work, the judge said that he struggled with what I can do and how I can help. The case is uncharted territory, and because the depositor's funds weren't the property of the Synapse estate, BaaS said it wasn't clear what the bankruptcy court could do. So this is a crisis, and I would like to see a resolution, but I'm not sure if people are looking for court orders. What I can provide in terms of court orders, BaaS said. So this is a hot mess, and let's go take a look at this. So this is another article that I believe was from the day before. The CNBC article was, June 7th. So this was from the day before on June 6th. So customers of several fintech companies that use the Synapse financial technologies to connect with banking partners are reported that they lost access to their funds in mid-May and are asking who can help. For reasons that Synapse and its bank partner, Evolve Bank and Trust, are still disputing at a bankruptcy court in California, fintech partners of Synapse, including Copper, Juno, and Yoda Technologies, Inc., have been unable to process payments for their end customers, while Evolve claimed it cannot distribute the funds because Synapse shut down the system abruptly without providing necessary records. Synapse claimed that it restored the system on May 13th, and Evolve's decision to freeze the funds has been unnecessary and punitive. So Synapse filed for Chapter 11 bankruptcy protection on April 22nd with a reorganization plan under which its assets would be acquired by instant payment company TabaPay Inc., but the deal was called off on May 11th, and disruptions appeared to escalate since then. One of the customers affected, Nicholas Michaud Jr., said he found on May 16th that the bank account he set up with his teenage daughter on the mobile banking app Copper was closed. He opened the Copper account in October of 2023 to let his daughter manage her own savings with guidance and visibility from a parent. Before the account was closed, his daughter had saved $1,730 in the Copper account by working a part-time job after school at a local florist shop. Michaud, a manager at a home care services facility in Bristol, Connecticut, did not expect to learn jargon like banking as a service, BaaS. The whole thing is just a mess, Michaud wrote in a message to S&P Global Market Intelligence. I'm not in the financial world much and had to self-educate myself about the BaaS banking model just to try and understand what has happened and transpired. And then complaints directed to the Fed. However complex the terminology can get, customers wish to get their money back is simple. And then customers confused by FDIC language, a bankruptcy court, under particular scrutiny are the efforts that fintech companies make to educate consumers that non-bank products are not covered by FDIC insurance. Bingo, bingo. Money deposited through a fintech like Copper or Juno is supposed to end up at the company's FDIC-insured partner bank, but discrepancies in record keeping between a bank and a non-insured fintech can make the recovery process more complex and worrisome for customers in times of stress. And And then he's, of course, people go on to say, it's really not fair, whatever, blah, blah, blah. Well, consumers need to understand that, you're potentially not dealing with a bank. And even though you've got a fintech that may be backed up by a bank, you got to read the verbiage. You got to read the verbiage that's in the agreement that you're signing, because odds are you're not going to have FDIC insurance. And, if you do, it's going to be some type of conditional. And, and when basically stuff like this happens, the worst case scenario, companies start going bankrupt, you're probably going to be out your money. It sounds like a lot of people here are going to be out their money. And Synapse is they basically closed everything up. They filed for bankruptcy, fired all their employees, and they're out. There's $85 million missing. Now, I mean, you could go back and, the authorities could go back and prosecute the executives of Synapse for maybe mishandling funds, misappropriating funds, whatever the case may be, perhaps fraud. That could be a reality, but that's not going to get these customers their $89 million back, whatever it was, with 85 million. So this is not going to get their 85 million back. So now let's take a look at something else here. So this was a interesting article from PCBB. It was one of their BID daily newsletters. So it says regulators have a watchful eye on your fintech partnership. So when embracing new technology, it's important to consider the risks. Banks that dove headfirst into fintech partnerships and banking as a service, BaaS, have often been hailed as visionary market leaders. Now, some of them are being lacerated by banking regulators for failing to adhere to risk management practices in their haste to go digital. As one bank CEO dealing with an enforcement action noted, every bank that touches BaaS is getting an enforcement action. For some time now, community banks have been urged to partner up with fintechs as the quickest and easiest way to keep up with the tech revolution in banking and payments. Turns out that these fintech partnerships can also be a shortcut to regulatory purgatory. Fintech usage crackdown. A recent wave of enforcement actions against banks over their fintech usage has bankers on edge, and with good reason. The FDIC is clearly taking a close look at fintech in banking and isn't liking what it sees, particularly at smaller banks. Fintechs have become ubiquitous as community banks eagerly partner up to avoid getting left behind in the race for enhanced digital banking services. The need to closely manage those services for compliance with broader banking regulations has emerged as a significant issue. Here are a few of the recent cease and desist orders, known as C&Ds, and consent orders issued against banks by the feds. A Northwestern U.S. bank was hit with a C&D that required it to wind down its fintech's business strategy and enhance its risk monitoring and management. A New England bank entered a consent order to clean up its business practices with a focus on its dealings with third-party vendors and its BaaS offerings. A Midwestern bank was ordered to provide a full inventory of its third-party contractors and explain how the bank was managing risks associated with them. And then finally, a Southern bank was ordered to improve its risk processes and to ditch some of its fintech partners. Some common shortfalls emerged from recent enforcement actions. Federal regulators are finding sketchy compliance with anti-money laundering, AML rules, and combating the financing of terrorism, CFT regulations. And a lot of these problems revolve around fintech usage. The issue appears to be lax oversight and management of these fintech partnerships. Banks are being told to tighten oversight and management practices and improve risk management when it comes to partnering with fintechs. And then it offers some suggestions here, like ways to manage the risk. So number one, strong regulatory compliance, kind of like no duh. Number two, appropriate personal expertise, or, some employees lack the subject matter expertise to be able to effectively monitor and manage bank programs. Number three, proficient data analysis and monitoring capabilities, like systems and data are lacking to enable banks to effectively monitor and assess third-party relationships. And then number four, proactive and strategic board activity. Bank boards are not taking a strong enough role in policing the use of third parties and compliance with AML CFT rules. Okay, so those are all good suggestions. Here's a couple of things. Number one, I did a whole episode on, on basically partner. I called it partner or vendor. And I have this whole pet peeve about, basically all the, all the consultants and bank journalists or writers, whether it's American Banker or whatever, what have you, basically for years, there's these articles. Oh, you got to partner with the fintechs. You got to get fintech partners. You got to get this and that. I mean, just this major push, oh, you got to have the latest and greatest and fintech partners and everything. I don't like the word partners because they say on here, what happens when they say how to manage it? They always go back to, oh, what is it? It's a third party relationship. It's a vendor. You're hiring a vendor to perform a service to you. They are not a partner. A partner is somebody who shares in the risk and reward of the business. They're going to share in your profits. They're also going to share in the losses if you have losses. So whatever happens, they are sharing in that. They're also going to share in the risk. They're going to share in the liability of the business. So so a partner is going to, if problems happen, that partner is going to share in that problem. These fintech companies are not sharing in the bank's problems. Sorry, they're not. If the bank has losses or if the bank loses customer money, well, then the bank is out. The fintech is not going to be out that money. And so again, I don't mean to go on a rant on that. That's just a pet peeve of mine. Okay. The other thing is that, I wonder, what do you, it's kind of like this. I did a whole couple other episodes on, kind of what constitutes a good bank board, what makes up a good bank board, all this kind of stuff. And I just did that about 2 weeks ago. How, I guess the question becomes how deep do you want the board to do? Like, the board does not run the day-to-day operations of the bank. The board is there for oversight. It's to help with, the board is there to help set the strategic mission, visions, goals of the bank, and is to give the marching orders to the executive team to then carry that out. It's the executive team's job to run the bank on a day-to-day basis. It seems like, we kind of have this push to like, oh, well, the board's got to get out there and the board's got to get involved and just manage and run all this day-to-day stuff. And I don't know that I agree with that. And but I think here's the overall point here, that regulators have really been coming down on the banking as a service model. This model, which was a really good model in some respects. You had a couple of banks, like I think the Bancorp Bank comes to mind, who, they're the kind of specialty in credit cards. But you have several banks around the country that have made this kind of their primary model. And I think they're good at what they do. But there's also things that are happening now that are becoming more of a concern, like as far as the oversight, as far as there's lacks with the AML and BSA and the CFT with the, combating of financing of terrorism. A number of C&D orders have been put out. And then you have this utter disaster here with Synapse and their whole bankruptcy and the whole failure of their BaaS business model. So, I think this is a really interesting case, and it's going to be fascinating to see how this unfolds here over the next couple of months. Are these consumers going to get their money back? Can they find the money? If they can't find the money, how are they going to get their money back? Does the Fed or the CFPB or somebody have to step in and basically, give these customers some kind of a bailout of some kind or something like that? Like, I don't know. I mean, again, we're kind of in this, like it says in the article, we're in this like uncharted territory with this, but it's a really interesting thing to look at here right now. But I think the big takeaway is that, if you are, if you work at a bank right now, you really need to be thinking about your third party vendor management, and you really need to be taking a look at, you're talking with your risk officers, your security officers at the bank, what's going on with BSA and AML reporting, CFT, rules and everything. Like, what is our policies and procedures say? Are we following these things? Are we in compliance? Going back, maybe asking some very tough questions of your vendors and your third party relationships that you have with them. Because I don't doubt, when the FDIC, the OCC, when they come in to do their annual exams, they're going to be asking a lot of questions about this. That is for sure, and I think this is really going to, I think ultimately, however this plays out, you're going to see a major impact, unfortunately, at least in the short term, on the BaaS model. So we're going to have to keep an eye on that. And I don't think there's any doubt that there's going to be a tightening around third-party relationships and how banks manage and monitor those relationships. So again, very interesting case study, great thing to keep an eye on. So I'll kind of wrap up with this. If you like this episode, please make sure to like, share, and subscribe. That always helps the channel. Please make sure to check us out on YouTube, Rumble, and all major podcast platforms. Please make sure to leave your comments down below. I always love to get everybody's thoughts on these topics, and this is a very interesting one. And like I said, please go check out some of the other episodes that I posted up this weekend, and I will see everybody again real soon.